Hey everyone, welcome to the second episode of our podcast. I'm Przemysław Koper and I'm your host. Today we take a global tour through four major stories that are quietly yet powerfully reshaping digital money, payments infrastructure, and financial stability. From a Nobel-level warning to strategic state moves in China and Saudi Arabia, and then back to the world of banks, stablecoins, and decentralized finance. Let's dive right in. Our first stop takes us to the thinking of Jean Tirole, Nobel Prize winner in economics. In a recent article for The Economist and interviews with the financial press, Tirole warned the stablecoins, digital tokens pegged to fiat or other assets, may not be the safe harbor many believe them to be. He puts a spotlight on key risks. First, the assumption among users, both retail and institutional, that these coins are equivalent to bank deposits or fully backed safe assets. Instead, he points out that backing is often shaky. The underlying assets may be illiquid or risky, and if confidence wavers, you may get a run. Second, he emphasizes that payment infrastructure is a public good, not just a technological experiment. He argues the system that handles money flows should be designed with stability, accountability, and regulation in mind, not purely profit-driven speculation. Third, he connects the dots between recent US legislation, for example, the so-called Genius Act of July 2023, which opens the door for regulated entities, banks or similar institutions, to issue dollar-linked digital tokens. These developments, Tirole warns, may legitimize speculation more than enhance financial safety. Let's unpack it. When you hear stablecoin, you might think, yes, it's pegged to the dollar or euro, so it should be stable, right? But the word stable refers only to the peg, not to the underlying reserves, liquidity, redemption rights, or the governance of the issuer. If the issuer backs the token with risky assets or the redemption mechanism fails, you could end up with a run just like a bank run, except the oversight might be weaker. Tirole suggests that the fiscal burden of such a collapse could fall on taxpayers. Why is this timely? Because the stablecoin market is growing fast. And now it's not just fringe fintechs playing around. Major banks and regulated players are getting involved. We'll get to that later. Without strong regulation and transparency, what used to be crypto risk is becoming systemic risk. So here's the question for our listeners. If the rails of payments and money transfer become tokenized, who is the builder, who is the regulator, and who bears the risk? If a private token issuer takes a loss, should the public sector step in? Tirole says yes, we should be very worried. Our next stop is China. For years, the stance seemed clear. Cryptocurrencies in many forms were verboten. Mining was banned, speculation discouraged. Yet behind the scenes, things appear to be shifting. Here's what we know. While China's domestic market for retail crypto remains tightly controlled, there's growing interest and increasingly active steps around stablecoins, especially ones pegged to the yuan or issued offshore. As one analysis puts it, Beijing may be under mounting pressure. The dominance of US dollar-pegged stablecoins threatens China's financial control and the internationalization of its currency. In real terms, major Chinese tech players such as Ant Group or JD.com are reported to be lobbying for the issuance of yuan-based or offshore yuan stablecoins, especially via Hong Kong. At the same time, official meetings in Shanghai with the State Asset Supervision and Administration Commission are exploring stablecoins policy under tightly constrained conditions. What's going on? Think of it as more than crypto speculation. It's about currency power, cross-border payments, capital flows, financial regulatory sovereignty, and resisting dollar dominance. Let's highlight some commentary. When US dollar stablecoins proliferate, they may enable economic activity that bypasses the traditional dollar banking system, and this could undermine China's efforts to control capital flows and preserve its currency regime. By shifting towards yuan stablecoins or state-backed digital yuan systems, China can retain more of the payment and settlement value chain rather than letting US tech or financial players extract it. That said, there are big challenges: trust, liquidity, the fact that the yuan is not as globally used, and that China's capital controls remain tight, so China must tread carefully. Now, here is the reflexive paradox. Stablecoins began in large part as a way to escape state-controlled fiat systems, more private, more global, less dependent on one country's money. Yet what we're seeing, they're being folded back into national strategy, and states are harnessing them as instrument of independence. For China, the question becomes, is it better to ban private crypto entirely and instead roll with regulated stablecoins, or to let innovation bloom and risk losing control? The current pattern suggests the former route. As a listener, I'd invite you to consider, when money goes digital and it's tokenized, is the real competition between freedom and decentralization, or between states and states? When the rail becomes global, the underlying currency matters. Now let's shift to the Middle East, specifically Saudi Arabia. We typically think of blockchain in two ways: grassroots, disruptive fintech, or speculative crypto, but in Saudi Arabia, it's being used as a statecraft. According to recent data, blockchain-related business registrations in the kingdom surged by 51% year-on-year by Q2 2025, reaching over 4,000 active companies. The government is betting on blockchain to support its Vision 2030, its economic diversification agenda away from oil. The interesting thing, they're not placing emphasis on wild crypto experiments or broad retail adoption of speculative tokens. Instead, their focus is on cross-border payments, tokenization of assets, especially real-world assets like real estate, digitization of trade and administrative processes, controlled ledger, permissioned blockchain systems rather than fully open decentralized networks. In short, blockchain as an infrastructure for the state and its economy, not blockchain as maximally decentralized financial freedom. Recent reporting shows Saudi Arabia is now planning to integrate stablecoins into its financial ecosystem and to expand real estate fund tokenization as part of its growth drive. What does that tell us? A few things. The kingdom is pursuing first regulation, then the market approach. Many Western markets start with innovation and then regulate. Here, the state is defining the boundaries up front. This model emphasizes industrial policy. Blockchain is a lever for economic transformation, Vision 2030, rather than purely a fintech disruption. It also raises a deeper question. As blockchain networks become state-managed infrastructures, does the original ethos of centralization fade? Is the innovation still about liberating finance, or about making finance more efficient under state supervision? For listeners, this is a reminder to not see blockchain or digital assets as one-size revolution everywhere. Context matters. Saudi Arabia's example shows us a model of adoption that is less wild startup and more strategic state play. Let's rotate our lens to the world of decentralized finance, or DeFi. Once the darling of "let's remove the middleman" innovation, the sector is now facing a harsh reckoning. According to Chainalysis via its CEO Jonathan Levin, DeFi's rapid growth has outpaced the maturation of its security practices, with user assets estimated to be roughly 140 to 150 billion. The surface for attacks is substantial. Hackers, including state actors like Korean People's Army, DPRK affiliates, are scanning for weak links in popular protocols. What does this mean? Many DeFi protocols emphasize cold is low, but lower the barrier to entry for attackers. Audits, bug bounties, formal verification are still uneven. The assumption that decentralized equals safer is proven false. The cost of a major breach isn't just dollars lost, but trust lost. If mass adoption is to happen, users must believe the infrastructure is safe. Here is a framing for you. DeFi promised faster, cheaper, permissionless finance, but absent liability frameworks, safeguarding reserves, or clear recovery mechanisms, it becomes an experiment in which the user absorbs most of the risk. As we've seen with recent thefts and attacks, the question has shifted from if to when. And when the next big exploit happens, it might well trigger a broader debate. Is DeFi safe enough for mainstream finance? For our audience, this is core because if stablecoins are entering the mainstream, as Tirole warned, and banks are embracing tokenized assets coming next, then DeFi serves as the wild frontier. But will the frontier set the standard, or will industry move cautiously away from it? Finally, let's zoom out and look at the power players, the banks. A few years ago, banks were cautious about crypto. Today, many of them are launching stablecoin-related projects. In 2025 alone, names such as SG, Citi, ING Group, UniCredit, Standard Chartered, and so on have announced or launched stable token-based initiatives. The narrative is shifting from crypto outsiders to tokenization as a tool for settlement, digital assets, and interbank transfer. Who's driving this? Efficiency. Digital tokens can move value faster with lower cost, especially cross-border. Demand. Institutional clients and corporations want tokenized assets, liquidity, new product types. Regulation. In some jurisdictions, Europe's MiCA for example, the regulatory framework is becoming clearer, giving banks confidence to participate. Competitive imperative. If fintech and non-banks began to erode bank value chains, traditional banks adapt by issuing tokens themselves. What does it mean for the idea of decentralization? It means a potential rerouting. Instead of blockchain is decentralized peer-to-peer, we might end up with blockchain is tokenized rails under bank regulator domination. Consider this thought experiment. If major banks issue their own stablecoins and these become the dominant means of digital money movement, are we entering a new era of banked blockchains rather than free blockchains? And what happens to the original promise of decentralized finance and open money? Hey, let's summarize the major takeaways. Stablecoins are not innocuous. As Jean Tirole warns, the risk is real. What seems like a stable deposit may be a complex financial instrument with hidden risks. States are reshaping digital money. China is evolving its strategy. The era of banning crypto may give way to a tightly controlled stablecoin infrastructure as part of its push to internationalize the yuan and maintain payment control. Blockchain adoption can be state-engineered. Saudi Arabia exemplifies a model where blockchain is not disruptive chaos, but strategic infrastructure for the state, emphasizing real-world asset tokenization and regulated digital rails. DeFi's wild frontier still has wild risks. The decentralized finance playground is rife with innovation, but also with security gaps and user risks, and its role in mainstream finance remains uncertain. The institutionalization of tokenized finance is underway. Major banks are no longer on the sidelines. They are issuing tokens, stablecoins, and interrogating digital assets, signaling the move from fringe to mainstream. The decentralization question remains alive. If digital rails become institution-dominated, the original vision of open, permissionless finance may be reinterpreted. The real question: will money in the digital age be more open or just more efficient and regulated? For you, our listener, keep asking the right questions. Who issues the digital money? Who controls the ledger? Who bears the risk if something goes wrong? The answers matter. I think that's it for today. Thank you guys for joining this episode of our podcast. Stay tuned, stay curious, and keep your eyes on the tectonic shifts beneath our digital economy. I'm Przemysław Koper. Until next time, cheers.